Thanks for tuning in back again to the Alternative Bet. We started off this series with neo asset management and talking about the various forms of alternative investments present in the country. And towards the end of the previous episode, we gave a small slice of private credit funds or the concept of private credit. Now, we thought today's episode, let's just dwell deep into private credit. What is private credit? What are the nuances around that investment or that asset class? And how can investors take advantage of what is promising to be a very large market in its nascency? And the two co-founders of Neo Asset Management, Puneet, Jain and Hemant Daga with me. Gentlemen, good talking to you guys again. And I love your office, by the way. Very nice, very modern, very young, and which is what I believe private credit as a space is to India as well.
Absolutely. We love hosting you also, Neeraj.
Thank you so much. So let's talk about private credit. Now, give us a sense of what is private credit.
So, conceptually, Neeraj, if you look at any company's balance sheet, it typically has two sources of capital, equity and credit. And equity, companies can go through stock exchanges, they raise public equity, that is called, stock markets, public equity. When you replace public with private participants, you replace it with individuals giving money to a company to raise equity, that effectively becomes private equity. So instead of public, the word private replaces it. That's public equity, that's private equity. Now, as I said, every company has equity, every company has debt. Similarly, in the business of credit, there are two sources. There is public credit and there is private credit. Public credit is when, companies go and raise money from the public at large, whether it's through NCDs or through fixed deposits. Very standardized terms, everybody has access to the same collateral cover, absolutely standardized in that sense, right? And that's why it's called public credit, similar to public equities in that sense. Now, when an individual or a fund manager goes and does a bilateral credit deal, he gives credit to a company on a bilateral basis, which is far more customized, structured, collateralized in a unique way. That is what is called private credit. So effectively, similar to private equity, there exists an asset class called private credit, where individuals such as you and me, where asset managers such as Neo give credit to companies on a bilateral basis. These are far more structured deals, typically given to mid and small size companies. It acts as a source of capital for them. And it can spur growth of these companies where typically they might not be able to access banking channels in some situations, For example, if a company wants to do an acquisition finance, for example, if a company wants to grow but doesn't want to dilute its equity, it would require debt. And in those situations, for growth financing, it might require private credit. And that is the domain of private credit. So effectively, in a nutshell, it's a bilateral deal done between two or three counterparties with the company. You're giving credit to the company. And as an investor, we earn returns. We derive comfort from the cash flows of the company, from the profitability of the company, and also from the collateral cover, which acts as a second line of defense, like last time you were explaining. So there is cash flow from which you get paid your interest, and there is collateral from which, as an investor, you derive comfort.
Yeah, it kind of safeguards the amounts that have been given to the company.
Absolutely. So the first line of defense is cash flows. As I said, all investing is about cash flows, right? At the end, it's only about cash flows. So cash flows is your first line of defense. Collateral is your second line of defense. And the good thing is these deals are bilaterally structured. So there will be terms and conditions that the borrower cannot exceed a certain amount of borrowing. His covenants will be in place. The collateral will be ring fenced. There will be control upon the bank account. All money coming in the bank account will have an escrow control. So it's a very guided way of approaching credit rather than a more public credit, which is very pari passu, everybody equal. You don't have these controls. So private credit is a far more bilateral structured credit approach. And the need stems from borrowers because sometimes they cannot access banking channels for certain users. As I said, if a company wants to grow, but it does not want to raise equity, it can raise pseudo equity in the form of credit, right?
Got it. Okay.
If two brothers are in a family and one brother wants to settle his other brother, which happens in real life, if he requires money for this, he will access private credit for that.
Okay.
He cannot get banking money for that.
So multiple use cases.
Use cases.
Okay. So that's, viewers, that's in a nutshell. Now, we've kind of understood basic. Now, let's peel this off layer by layer and try and understand this. So either of you, and Puneet, maybe you can come on this as well. Let's first talk about this market, because not too many people know about private credit and the investability. So how is the market worldwide and how is it in India? Because I believe that you guys have done this in your previous avatar as well. So tell us a bit about the evolution of this industry, either of you.
So I think this market has existed forever.
Okay.
So because private credit is ultimately giving money being given by a private individual on a bilateral basis to a particular need. So I think this has existed forever. But if you look at the modern era, let's just look at US. In US, this has become a very, very big industry from 80s onwards, where companies like Oak Trees of the world, KKR, Apollo, etc., each one of them have become more than $100 billion of size. In fact, between these three, the size will be more than $500 billion of size. Similarly, in case of India also, this industry has grown very fast over a 4 to 5 year period.
Okay.
At this point of time, the total amount of money being invested on an annual basis is more than 10,000 crores.
And what was it at the start? This was five years back. So let's say around 2017-18.
Yes, around say most of the industry started post 2016.
Okay.
So which means that over a 6-7 year period, this industry has become more than 50,000 crore in terms of size.
Okay.
At this point of time, it is attracting investments more than 10,000 crores every year. It is growing at a pace of more than 12%. The growth definitely is significantly faster than either banking credit or public equities. I would say that among the various sub-segments in financial industry, this segment is growing amongst the fastest at this point of time.
Okay, so when you're saying that this has always existed, you're talking about how in the layman culture, मतलब मुझे धंधा बैठानी है तो आपने मुझे पैसा दिया, so that always existed, but in the form of a fund investing into a company that has started largely post 2016.
Yes.
Okay, and growing at 12% per annum.
Yes.
Okay, and is that the kind of growth that happened back in the other countries as well when it started? I'm just trying to understand if India is growing at a faster pace than what happened to other countries in its nascency. Any thoughts there?
Actually, there's an interesting one, Neeraj. If you look at global markets, private credit saw a major boost post 2008.
Okay.
Globally, what is happening, and this is a very important point, globally, banks are becoming tightly regulated organizations, right? And that's why a large part of lending is moving to asset managers. Because asset managers don't run any asset liability mismatch.
Yeah.
And when you're doing structured lending, you don't want asset liability mismatch. I think that's been our biggest learning in the last 3 years, right? So which is why asset managers are the best suited vehicles. This industry globally has grown 15% per annum. India is witnessing similar rates. Today, globally, this is more than $1 trillion of alternative assets. Total alternative assets globally is $15 trillion.
Sure.
Private credit is the fastest growing alternative asset class. And you'll be surprised, I think a lot of this comes from its returns profiles also. Returns have been extremely resilient.
Yeah, and I was going to come to that, but I just thought we'll first tackle the structure. So you're saying that globally it is growing at a rate of 15%, and in India too, right now it is about 12% and growing at a fast clip, and it'll accelerate as time goes. Okay, so guys, what is the structure like? Is it an AIF structure? How do I as an investor, let's say if Neo is having a private credit fund, if I'm not wrong, so how do I as an investor give money to Neo, and how does then Neo put the money to work? Can you talk a bit about that? Either of you again.
I'll take a shot at that. So yes, investors can participate in this big opportunity through alternative investment funds.
Okay, this is an AIF structure.
This is an AIF structure, and these are category 2 AIFs, basically meaning a tax pass-through status. Typically, the way these funds work is an investor says that I would commit 1 crore to this fund, right?
Which is the bare minimum.
Which is the bare minimum. So he puts 1 crore to work and he says, this is my commitment. But in a debt instrument, typically asset managers don't take all the money upfront. Because in a private credit AIF, as an asset manager, we will do 15 to 20 investments. Doing 15 to 20 investments will typically take 2 years time, because every single investment takes 2 months, 3 months, right? So typically we would take money in installments. Because why would I take your money and just put it in a liquid fund at 6%, right? That was not the purpose for which you gave me the money. So we take money in installments. These are typically called drawdowns in a more technical term. So we take money in installments. If somebody commits 1 crore, then today he might need to pay 20%. Then after 3 months, he might need to pay 20%, and so on and so forth. So typically over 15 to 18 months, the entire 1 crore is put to work. So the entire money is not going one shot as such in these funds. And investors can participate through alternative investment funds. The good thing is, I think SEBI has truly, direct classes have also come in AIFs. So investors can take benefits of direct classes also in these AIFs and can enjoy lower costs in transacting in these funds.
Okay. Oh, well, can you just explain that point once more?
Absolutely, Raj. So the way the mutual fund industry evolved, there are regular classes and there are direct classes, right? Direct classes typically have slightly lower management fees. Similarly, in the alternative investment industry, I think what SEBI has done is amazing. I think this will spur the industry even further. There are regular classes and there are direct classes. So for savvier investors, they can just directly access it
without the middleman or the advisor being there to tell them where to go.
Yes, and for people who are just learning the rope, it's always best to use an advisor because the advisor can tell him which fund is better. They can come maybe through the regular channels, but for larger clients who've done this themselves, they can take benefits of lower fees.
Okay, great. Okay. Just before I come to Puneet about what is the kind of investments that happen, Hemant, just one quick follow-up. What are the kind of fees that an investor has to pay through both the regular and the direct channels?
So fees on these funds typically vary, Neeraj, but ballpark, most of these funds have a fixed fee and a performance fee.
Okay.
Fixed fees would typically be in the range of 1 to 1.5%. And then there is a performance fee, which is typically 10% or 15% performance fee above a certain threshold of, say, 10 to 12% pre-tax return.
That's pretty similar to what an equity PMS anyways has been doing.
Absolutely. It's very similar. It's very, very similar to an equity PMS because returns are also relatively similar.
Got it.
The good thing is, at Neo, this is one of our philosophies to keep the fees probably the lowest because in debt, and this is very important for investors to understand, I think post-fees returns in debt investing matters significantly.
Sure. Yeah, makes sense. Okay, so that's a few layers peeled, a few more left. So Puneet, I would love to understand, one, what are the kind of returns that an average fund can give? Because Hemant spoke about how the post-fund returns or post-fee returns are important. And how does a CIO generate those kind of returns?
I think yes, it's both easy and difficult. It may look easy because I would say easy because the asset class per se has a lot of advantages. Because unless the asset class has certain advantages, there's a right to win in this asset class. And funds in US, funds in Asia, funds in India have delivered returns in excess of 20% odd. So which means that asset class is strong and has capability to deliver returns in excess of 20% on a consistent basis. The difficult part is execution. The difficult part is making sure finding the right opportunities, working with those set of management and having the right structure so that it creates a win-win opportunity for both investor as well as the borrower.
Sure, got it.
And I will typically split these deals into 3 categories. So first and very important category is sponsor financing.
Okay.
Wherein we will give money to a sponsor and sponsor may have a requirement of increasing equity stake into an existing company or maybe acquiring some other business.
By sponsor, you mean the person which is taking the money or the company which is taking the money?
So by sponsor, which means that one is there is an operating company and one is the promoter of the operating company.
Okay.
By sponsor, I mean the promoter of the operating company.
Okay.
So this is at the sponsor level.
Got it.
So typically in case of credit, money can be taken either at the operating company level or money can also be taken at the promoter level. At the promoter level, it is called sponsor financing.
Okay. Just a follow-up, why would a fund be comfortable giving the money to a sponsor? Because the sponsor will not have the operating cash flows that a company would have.
Yes. So this is a very, very important question. In many cases, what happens is that sponsors sometimes get ability to purchase stakes at some discount to market prices. So the best example could be that the sponsor may be able to buy an equity stake from a private equity investor who may have originally invested. So in that case, he's getting an opportunity to consolidate his stake, to improve his stake, and to improve his position within the company itself.
Sure.
So the repayment may be from two sources. One is that sponsor itself may have some small businesses which can repay. Otherwise, the repayment can be from dividend, or repayment can be from sale of stake at a later stage, maybe through a IPO, or maybe to other investors at a later stage.
Okay.
And this is a pretty large market.
Got it. Okay. So you kind of ring fence via agreements with the sponsor about how the repayment is going to take place.
Yes.
Okay, great.
Yes.
See, the good thing in private credit is, I think the path to exit is relatively well defined. And there are covenants which try to move in this direction.
Got it.
So as an investor, you're in control. As an asset manager, we are in control of our destiny. And that is the comfort that this asset class gives. So there is cash flow, but there is a path to exit.
Yes.
And unlike public credit, it's a very general path to exit, right? But here there is a very directed path to exit.
Sure.
Right?
Very predictable.
I would say very directed path to exit.
Very directed path, yeah. And the returns in that sense. Okay. So just before we come to, let's first get the three parts out. Then I would want to talk about the kind of defaults that might happen as well, and so on and so forth. But you mentioned sponsor financing as first. What is the second one?
So the second part will be working capital financing or growth financing.
Okay.
So here there are many cases where the plant is built, the capex has been done, but there is not adequate financing to take the plant to the optimal level.
Okay.
Let's say
the person has run out of money for
the
whatever
person has run out of money.
Absolutely.
So the plant may be running at 60% capacity utilization. The entire machinery is there. You just need to pump in certain amount of money, and the capacity utilization can go from 60 to, let's say, maybe 90%.
Got it.
In this case, the borrower is able to earn returns maybe in excess of 50% on our capital, and will have no challenges paying our return of 20 odd percent, given the extent of benefit involved by taking that money.
Okay, 20 odd percent. I had not gotten to the returns part, but thankfully you gave us a leeway there.
This is a very interesting one, Neeraj. And working capital finance, growth finance, last mile financing, these are all words that are used interchangeably. But effectively, what you're trying to do is you're trying to put 10 rupees or 20 rupees to work, and you're sweating an asset which is worth 100 rupees. So by putting that last mile connectivity of capital, the 10 to 20 rupees is actually sweating on an asset base of 100.
Right.
So technically now on 100, if you make even 15, on our 10, 20, the returns get hugely magnified. And which is what I think Puneet was saying, it's actually a win-win. This capital is highly productive. It's capital which is productive for the investors. It is capital which is very productive for the borrower also.
Why is it that is it because of the nature of the norms that promoters are not able to access this money from the banks or financial institutions? Because there are a bunch of financial institutions out there as well. So how does private credit come in the first place?
So there are several situations. Like, for example, as a promoter, you set up a plant, right? Now, initially, banks will fund you for the cost of the project. But if there is a cost overrun, banks typically will not fund you for cost overruns. There can be cost overruns in real life, right? Usually there are. Now, there can be situations where there is a project which is, let's take a real estate a building, right? Building is almost ready, 7 floors out of 10 floors. It requires capital for 3 floors. Typically, last mile financing in real estate from banks is typically not available. So that's also a situation, right? Working capital has got stretched. Say suddenly raw material prices have gone up. Working capital has got stretched. Banks are comfortable only up to a certain level. In those situations, we feel, no, this capital is actually, making a lot of sense, because banks will follow a relatively cookie cutter approach sometimes, right? And but as an asset manager, you can take a view that this capital will actually sweat the asset even more.
Sure.
So that's why all these opportunities come about.
Got it. Thanks for that explanation. Okay. So Puneet, that's part 2. Now part 3, sponsor financing, working capital financing. What's the third one?
Part 3 is refinancing.
Okay.
And I think The best example to explain this will be the hotel industry. Like if you look at the hotel industry, typically they get financing for a 7 to 10 year duration, but a hotel asset is continues for 30 40 years or perhaps. Now what happened was, let's say hotels which were set up maybe 10 years back, they would have repaid the money, but because of COVID they lost 3 years. So at this point of time, the hotel industry is doing very, very well. They are having the best of cash flows, but they are not able to make full 100% principal repayment. So what they just require is elongation of the liability period.
Sure.
So principal repayment, which were due possibly this year and next year, will be rescheduled to pay over a 4 to 5 year period. These companies are making large, very healthy cash flows.
Sure.
There is security cover which is more than 2.5 to 3 times. Risk possibly is a lot lower given the fact that hotel is running, while initially when the money was given, the hotels were at a land stage. These kind of opportunities cannot be accessed by banks because banks typically do not do refinancing. So in these kind of refinancing, and this is the most juicy segment of private credit, your asset managers like us, have the sole play.
Got it. Okay. And you guys are saying that banks which have lent 10 years ago, currently when it comes up for renewal, because the bank manager also, or the bank finance executive can also see that the hotel industry is in a good shape, they cannot extend the tenure.
They cannot refinance or
They cannot refinance.
They cannot restructure that loan.
Okay.
Because then there is moral hazard involved, right? Because technically as a regulator, you will not be able to judge whether it was done for right or wrong reasons.
Got it.
And only when an external party does it, then that vetting happens here.
Okay. Now, Hemant, Puneet mentioned something in the second answer, which is the kind of returns when it came to the working capital piece, which is, I think I heard the number of 20-odd%. Now, that's remarkable for a product with so much of predictability as well. Tell us a bit about the kind of returns that private credit is making in India, a proof of concept in India, and how does this differ from what could be happening in the rest of the world?
So I'll start from rest of the world.
Okay.
There's a longer history, and these are far developed markets, right? In the US markets, Neeraj, in the last 10 years, the top 25th percentile funds, okay, have delivered 13% compounded dollar returns.
Wow.
13%. The US equity markets have delivered 8% compounded in this period, right? Now, typically in US, if something delivers 13% and you assume a dollar rupee depreciation of 4% every year, that should very, very intuitively translate to 17 to 18% rupee returns, right? So we are not talking anything out of the whack in that sense. If in the US there is 13% dollar, just apple to apple, that should be 17 to 18% rupee in India. And the very fact that India is a market which is nascent, growing phenomenally, I think returns will be slightly better than 17 to 18 because US is a far developed market, which is why in India, most of the asset managers and even Puneet and me in our previous avatars, we've delivered slightly northwards of 20% gross IRRs. And that's true for many asset managers in the country, large asset managers who have raised more than $1.5 billion from sovereign wealth funds.
Compounded over how many years?
Compounded typically over 3 to 4 years. These are relatively shorter durations in that sense, but compounded over this period of time.
20% CAGR for 3 or 4 years.
Absolutely.
Wow. Okay.
And once again, the point I'm trying to make is, it's not out of the whack. In the US, if 13% dollar can be delivered, which is higher than US equity markets, and you adjust for the dollar rupee, 17 to 18% rupee is a very natural expectation. And just what in the last 10 years, just look at the macro context. In the last 10 years, inflation in India was far higher than US. Interest rates in the US were far lower. Despite that, $13 got delivered. So you have to put that in context. And if I have to just complete this, Puneet made an interesting point on working capital finance. I'll give a very intuitive example. This might not be the exact way it plays out in the real world. Assume I am a promoter, I put up 100 rupees plant. right? Any plant, a 10% return on capital, will you be happy with that? That's very normal expectation, right? So on 100 rupees, I will be able to make 10 rupees, right? Now assume I've run out of working capital for some reason or the other. And we as asset managers come and give you that 10 rupees working capital to start the plant. Now, when we give you 10 rupees, that 10 rupees will produce 10 now. Otherwise, it was producing 0. Now, technically, as a promoter, you're making 100% returns on my money. Now, in this situation, for a short period of time, if we say, give us 2 rupees, you out of the 10 that you're making in absolute terms, and think in absolute terms, Neeraj, out of the 10, give us 2. Will you do it? Any normal person will do it, right? So in percentage terms, it sometimes sounds high, but in real life, what happens is in a company's life of 30 years, 2 years or 3 years is more about absolute maths.
Sure.
It's not necessarily about percentages.
You're almost making it sound that not in a negative way, but a private credit fund looks at an opportune time to give credit to a firm in need in order to execute the last mile, which enables the company to earn the returns that it is supposed to earn, which it wouldn't have been able to do without the availability of the credit. And therefore, the company or the promoter, she or he, is ready to pay you a slightly larger than what it normally appears to be return, because that's the oxygen that was needed to finish the task, so to say.
I think absolutely yes. I wouldn't use the word oxygen. Oxygen means, desperateness. Here, that money is making the asset sweat better.
Okay.
The asset is already there. It's a performing plant. By providing that extra 10 rupees, the asset is sweating better.
Okay.
So I wouldn't use the word oxygen. This is not a case of, desperateness.
Sure.
There is logicalness to this 20% getting earned.
Got it.
And I'll personally just add also, like it is well accepted that private equity can deliver returns which is maybe say 500, 600 basis points higher than public equity. Similarly, the same construct applies for private credit as well, where a private debt can deliver returns which is maybe 600, 700 basis points higher than public debt.
Sure.
A typical public debt is available in a zone of maybe 10 to 14%. So if you just add up maybe 6 to 8%, you are at a range of between 18 to 22% for, let's say, private debt.
Absolutely.
Here's the thing, right? Okay, first let me get the risk factor out of the way, because the question that I will obviously ask you is that if you can, let's assume a fund is 4 years, but at the end of the first fund or whatever, let's assume you have one fund, and at the end of the first fund, I'm sure you think about the second fund, right? Per se. So in effect, if you are a continuous journey, a continuous loop of funds which deliver nearly 15 to 20% year after year over a period of 10 years, then you are effectively giving returns which are more predictable. I'm using that term, although you didn't, more predictable than equity returns at a far lower risk than what is there in equity markets.
That is the compelling case for private credit.
Interesting.
But
what are the risks to this then, Hemant? That's the key point. Sorry, I don't know if you're making a point, but after that, I would love to understand what are the risks to this, because this sounds very positive.
So firstly, I wouldn't compare this with equities. I think, last time when we discussed, I think all asset classes have a place in the sun, right? Whether they are equities, whether they are debt instruments. It depends on your asset allocation at the end of the day. What are the risks in this? I think risks are more, obviously, in any investing. I think taking a call on how that industry and how that company will perform in the near term is very important, right? Because we are finally all earning out of the cash flows of the business. So if there are severe downturns, if there is a severe dramatic change to the business model, then will our returns get impacted? Obviously, they will get impacted, right? It is like saying when you invest in a stock and there is a sharp downturn, your returns will get impacted. The good thing is private credit is resilient as an asset class. I mean, even when we look at Indian markets and the kind of private credit returns that have got delivered, despite COVID, people have delivered 20% returns. So there is resilience, but at an individual company level, can it get severely impacted because of a sharp economic downturn in its sector? The answer is clearly a yes. Puneet, would you love to add a few more?
Yes. So another important risk in terms of investing is that in many cases, promoters do not want to dilute, and they think that private debt can be a solution of not raising equity. But that that immediately emerges as a risk, because equity has to be paid over a longer term period, but private debt as an asset class has to be repaid over a 3 to 4 year period. So therefore, they can be an asset liability mismatch. So wherever private debt is as a substitute for equity, one has to be very, very careful in terms of investing. So the another important part is in terms of flexibility of payments. So so uh, so if you're investing with a certain horizon, and if the company starts to do well, you should be willing to take payments faster as well. So to make sure that you align your cash flows completely in terms of performance of the companies, you should not provide excess capital than what the corporate requires, because ultimately you are generating returns which are slightly above normal. So you should also make sure that even the incremental capital which a corporate is generating also meets the benchmark of the money which you're lending. But yes, so you have to tick mark various boxes, and once you tick mark various boxes, you follow the investment very carefully. The chances of losing capital are actually very minimal, at least in my experience, and maybe Hemant can also speak. In my experience, of all investments I have done, I haven't lost capital. So therefore, yes, if you tick mark various boxes, risk you may end up losing some return, but risk of losing capital are actually very, very low.
And I'll give an intuitive explanation of that. You know what Puneet said, where the risk of capital loss is minimal. So Neeraj, typically all investments are backed by cash flows. And the first starting position, and I want to re-emphasize to all the viewers, it is about cash flows. Okay. Collateral is only a second line of defense. Now let's assume the cash flows for some reason or the other don't pan out. That can happen in real life. Now we have collateral, right? Typically, most lending is done at least at 2.5 to 3 times collateral cover, right? So effectively what you're saying, against 100 rupees, you've got 250 rupees of collateral. Now, very interesting statistic. I think in the last several years in India, whenever resolutions have happened of slightly stressed assets, resolutions have also been typically yielding 40 cents to a dollar.
Yes.
What does that mean? Against your 100 rupees, you've realized 40 rupees. Now, how much collateral did we have, Neeraj, in this case? 250. Now, on 250, if we have to realize 40 cents, that means your 100 rupees will come back. And which is why it's very intuitive that at least if you've chosen an asset well with decent diligence, right, and you are decisive, then on 250 to recover 100 is not an unreasonable task.
What's been the default rate for your funds, whether in the previous avatar or at Neo? I believe you guys have a fund as well. Maybe we just started, maybe. So the number of years is not 4 years, but lower. But what is a typical default rate here?
So once again, Neeraj, I think there are two terms that I would want the viewers to get used to. I think default, and there is a word called loss given default.
Okay.
A company can default and yet there can be some recoveries out of it, right? Because all assets don't collapse. So can there be delay in interest payments in some of these lendings? The answer is a clear yes. During COVID times, did we witness delays in interest payments? So is that a default? The answer is a clear yes. But as long as fundamental value in the asset is there, see, we lend to an asset which was generating cash flows. It's like saying a stock doesn't do well for 2 quarters, but does the company go out of fashion? Absolutely no, right? At that time, we typically tell viewers you should add if the company is fundamentally fine. So default and loss given defaults are very important words. Can there be delays? Can there be defaults? The answer is yes. Out of 100 companies, can that happen to 7-8 companies? The answer is a yes. Now, can there be delays in 7 to 8 out of 100? Yes. But losses, I would say maybe 1 or 2 out of 100.
Are you saying that out of the total money, let's assume you had a 100 crore fund, and that 100 crore was invested in the past, in your previous avatar as well, the losses have been maximum to the tune of 2 crores? 1 to 2 crores. Okay. And that's not a certainty, of course.
That's not a certainty, but this has been stress tested.
Is that an industry-wide trend as well? Just trying to understand.
In most funds, I would say that.
Okay.
Obviously, it depends upon diligence levels, the teams, and that's where specialization comes to fore. That's where investors should carefully evaluate teams, right? Teams that have delivered across economic cycles. But typically, that's an industry-wide phenomenon.
Okay. Great. So we've gotten a decent understanding of what this product is about. Is there something that we've missed that you would like to add before we wrap up this episode? I believe we covered risk and the nature of the thing. Is there something that we missed?
There's something that I would want to cover is I think the cash flows to an investor. This is a regular income product, right?
Okay.
And typically, when Puneet was saying that 18 to 20% gross returns can be generated, out of 18 to 20, the good part, Neeraj, is 10 to 13% or 10 to 14% will come as regular cash flows. And typically, once you take a time as an asset manager, we will take 1 year to invest, right? But after that, every year, regular cash flows go back to customers. And cash flows can be interest payments plus some principal returns. So on your 100 rupees, typically 25% can be regular cash flows, interest plus principal repayments. And that is the beauty of this asset class. It gives you very regular cash flows. And finally, if cash flows are coming, that means your returns are safe. That means your returns are getting crystallized.
Yeah, most certainly. Okay. So, if I can summarize it in some fashion, you're not taking the entire 1 CR or whatever the minimum number is, or whatever the number is at one go, but the cash flows start coming in periodically through the life cycle of the fund, be it 4 years, 5 years, as the case may be. And you guys are saying that globally it is generating about 13% return. You have experienced 15 to 20% return, 20% if I'm not wrong, CAGR, for a life cycle of the fund, which is about 4 to 5 years.
Absolutely, Neeraj.
Great. Jain, this was lovely. A lot of knowledge shared about private credit, and it's an interesting asset class. May it prosper. And thank you for sharing the details with us.
Thanks a lot. Pleasure always interacting with you.
Thank you. Thank you so much. And viewers, thanks for tuning into yet another very interesting and a new concept introducing episode of The Alternative Bet.